Have you ever wondered how an influx of new apartments and a trade war with the United States could impact the Canadian multifamily real estate market? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. The Canadian multifamily market is facing significant pressures from both domestic and international fronts. According to a recent report from Oxford Economics, the surge in new apartment supply and the ongoing trade disputes with the United States are creating a complex landscape for investors and tenants alike. In May, Canada's average national asking rent was reported at $2,129 per month, marking a 3.3% decrease from the same period last year. Cities like Calgary, Vancouver, and Toronto have experienced some of the most notable declines in rental rates. The report highlights that the completion of new multifamily units jumped by 35% in 2024, significantly increasing the country's rental supply. Oxford Economics forecasts that this trend will persist as more purpose-built rental units, currently under construction, are completed and integrated into the market. Despite the increased supply, demand pressures are evident due to slower immigration and fewer temporary residents, which are expected to curb rental demand. However, there is a silver lining amidst these challenges. Worsening homeownership affordability and financial strains on households, exacerbated by the trade war-induced recession, are expected to sustain rental demand in the coming quarters. This could provide some stability to the multifamily sector, even as the broader housing market faces headwinds. Internationally, tensions between Canada and the United States have been heightened by President Donald Trump's threats to escalate the trade war unless Canada rescinds its digital service tax targeting U.S. tech giants. In response, Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, aiming to reach a resolution by July 21st. While there is no certainty of a deal, the potential for easing tensions could bring positive developments for the Canadian real estate market. The multifamily market is also experiencing some rebalancing. CoStar Market Analytics notes that vacancy rates are approaching more balanced levels in traditionally unaffordable urban markets like Toronto and Vancouver, while Alberta sees rates moving towards cyclical highs. These dynamics suggest that while challenges remain, there are opportunities for strategic investments and growth in the multifamily sector. The Canadian commercial real estate market experienced a slowdown in the third quarter of 2025, with total investment volume reaching $36 billion, a 12% decrease compared to the previous year. This contraction was influenced by several factors, including a proposed increase in the capital gains inclusion rate in mid-2024, a static interest rate environment in early 2025, and ongoing geopolitical tensions with the United States. These factors contributed to a cautious investment climate, with capital moving towards value plays and more resilient regions. Investment volumes declined across all major markets except Calgary and Edmonton, which saw increases of 3% and 25% respectively. The multifamily sector recorded $8 billion in dollar volume transacted, a notable 13% year-over-year decrease. Meanwhile, the retail sector was the only one to see a year-over-year increase, up 5%, with nearly $5.9 billion in transactions. Notably, food-anchored retail strips remained popular among investors for their defensive and inflation-hedging properties. In terms of regional performance, Alberta stood out with strong demographic and economic indicators. Calgary and Edmonton reported significant growth in investment volumes, with Calgary reaching $3 billion and Edmonton $2.7 billion. This was supported by interprovincial migration and robust economic forecasts, positioning Alberta as a resilient market amid national slowdowns. Conversely, Toronto and Vancouver experienced the steepest contractions, with investment volumes down 23% and 18% respectively. The Greater Toronto Area and Metro Vancouver regional district markets saw a reallocation of capital to more affordable regions. However, Vancouver managed to reclaim the top spot as investors' preferred market across all asset classes, according to Altus Group's latest investment trends survey. The industrial sector in Canada also faced challenges, with nearly $9.1 billion in dollar volume transacted, down 5% year over year. The sector was impacted by U.S. tariffs and broader economic shifts, leading to a stagnant national industrial availability rate. However, Calgary, the Greater Golden Horseshoe, and Edmonton showed resilience with significant year-over-year increases in investment volumes. Looking ahead, Canada's commercial real estate market is at a crucial juncture, with expectations of the Bank of Canada's easing cycle potentially lifting investment activity by reducing borrowing costs. The trend of regional diversification is projected to continue, with high-growth markets outside Toronto and Vancouver remaining attractive targets due to their demographic fundamentals and lower operating costs. This period of slower investment and capital reallocation presents opportunities for strategic investments in resilient and emerging markets. Now, let's shift our attention to the CBRE's Canada Real Estate Market Outlook 2025. This comprehensive report gives us a snapshot of the Canadian real estate landscape as we look ahead to the new year. Canada finds itself at a crucial turning point across various fronts, including political, economic, and social issues like housing affordability and congestion. Despite these challenges, Canada remains a promising growth opportunity. The country ranks among the top G7 nations in GDP, population, and employment growth over the next 5 years. These factors are closely linked to the demand for all types of commercial real estate. As we enter 2025, we're poised to see increased activity in the market. The easing of the cost of capital crisis is expected to unlock more investment and leasing activity, contingent upon global bond market conditions. Leasing fundamentals are improving overall, although Canada has seen a substantial increase in new supply across the office, industrial, and residential sectors. This new supply will take some time to be absorbed by the market. However, it's important to note that these developments are part of Canada's long-term growth strategy, which remains strong compared to other G7 countries and favorable for commercial real estate demand. Looking at capital markets, sentiment is on the upswing, and stronger investment activity is anticipated in 2025. More capital is expected to be drawn off the sidelines as cap rates for certain asset classes start to compress modestly, depending on global bond market conditions. This presents a potential opportunity for investors looking to capitalize on the evolving landscape. In the debt markets, availability is predicted to improve, yet lenders will remain selective and nuanced. Credit spread dynamics should begin to normalize, and loan underwriting will reflect broader market trends concerning rents and vacancy rates. This selective approach could lead to favorable conditions for those who are well prepared and strategic in their investments. The multifamily sector, which is particularly relevant to our discussion today, faces near-term uncertainties due to immigration curbs and the delivery of new supply. However, the long-term growth fundamentals are solid and present a compelling investment thesis. This sector continues to be a bright spot for those looking to invest in resilient and emerging markets. As for the industrial sector, it is encountering challenges due to softer demand and an influx of new supply. However, the market is expected to continue working towards normalization, which could occur sooner than anticipated. This sector's resilience is key, especially as it adapts to evolving economic conditions. In conclusion, Canada's commercial real estate market is at an inflection point, offering both challenges and opportunities. The easing of the cost of capital and improving fundamentals across various sectors suggest that 2025 could be a year of growth and strategic investment. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.